We're live. The socials going here. Yeah, no socials. Where'd they go? All right. Well, let's get started. Hello, Smart Money 2 podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today, I'm joined here with Doug Hagren. Hey, Doug.
Good morning, Kirk. Hey, have you refinanced today? Because I understand that the Fed made everybody go out and be able to afford housing last night.
Yeah, I'm. What are the rates today? The mortgage rates actually, they've gone up. I had.
Oh no! I hope you locked in. Aren't you buying a new house?
I did. So I locked in 2 weeks ago, and it was I think 6 1/8. So 6.125, and it looks like online it looks like 6.59 as of today for the 30-year. So I'm not sure
what the Fed's looking for. Woo-hoo.
Oh, I'm not sure if they went up or down. I'm just looking at the rate, and I got a good rate, so it's possible that it's gone down. But anyway, so yeah, I mean, let's basically in the last week. I mean, it was a big deal this week on Wednesday when Jerome Powell dropped rates 25 basis points, which is nothing, and people are speculating that there'll be another 2 this year. There's another 1 to 2 this year, and 1 next year, and 1 the year after. I think that's the dot plot. I always find the dot plots funny because it doesn't mean anything. Because 1 next year, 1 year after, really? is that what's going to happen? You're not going to do anything? I'm sure they will. Anyway, obviously that was a big whole lot of nothing. Everyone was freaking out about it, and what happened? Nothing. Just crickets. So I want to talk about a few things. We've been talking about gold the last few weeks, and gold's obviously a big important trend that no one's talking about. And if you want to get into early to a trend, now's the time. I can tell you from my experience, no one's talking about gold, silver, mining stocks. Mining stocks are up 100% this year. Silver's up like I think 70 or 80. And no one's talking about them. So that is a good sign. That is the sign that at some point soon people will start to pile in. Then it'll start to get volatile. Until then, it should be good. However, what I want to talk about are a few interesting things that I found out that I just kind of overlooked. Now, when you as an investor, you tend to take a lot of things for granted. Right? You take for granted that buying and holding is a good strategy. You take for granted that the U.S. economy is going to be a good bet tomorrow as it is today. You take for granted that, U.S. treasuries will never default. Like there's a lot of things we take for granted, right? I'm not saying they're wrong. We don't calculate them in our risk. So if you're deciding whether to buy treasuries or not, people say, well, there's no risk in treasuries. Well, actually, there is risk in treasuries. We just don't calculate it. There's actually a lot of risks, and it depends on the kind of treasury. So if you're buying a 30-year treasury, there's a lot more risk than if you're buying a, like a 30-day treasury. So the thing to think about is, what are we taking for granted? Well, I was talking to a client of mine earlier today, and we were talking about the economy, and we were talking about tariffs. And I'm just taking our conversational points. I'm not confirming these numbers are accurate, but basically, rough estimate, we have 30 trillion in GDP, right? Only 14% of it is imports. 14%. I thought it was higher than that. I really did. I thought higher than 14% of our GDP came from imports. Only 14%. Out of that, 10% is subject to tariffs. Only 10%. 10% is subject to tariffs. And there's some more that is a part of trade deals, but basically net 4% of the economy has tariffs on it. 4%. So I didn't realize it was that low. I hadn't heard a single person talking about that when they're talking about tariffs. Tariffs are good. Tariffs are bad. Tell me the numbers. No one knows because people are just shooting out talking points. So if that's true, 4% of the economy has tariffs, and I haven't confirmed this, by the way, but I'm just using this as a framework to think. If 4% of the economy has tariffs, first of all, what are tariffs actually going to do? Probably not much. I mean, Trump talks about an external revenue service. Okay. But is it really going to do anything? I mean, 4%, probably not. I've always thought that tariffs were a bat that he can go around beat people with so he can get a better trade deal. That was the assumption I was under. And I think it's still true. But if it's 4%, it sure is true, right? That's the case. So think of all the things that you take for granted that you haven't stopped to think about, that you hear. I'll give you another one. Roth IRAs are better than traditional IRAs because they're tax-free. Well, on the surface, that might seem true. That's what we would call a half-truth, right? We talk about half-truths a lot in the show. That's what we call a half-truth. Roths are not better than traditional. If you actually run the numbers, you'll realize Roth IRA and traditional IRAs have the same exact outcome, everything else being equal. If Doug and I put $10,000 in today when we're 20 years old, he's got a Roth, I got a traditional, and then 30 years later, we take the money out, we will end up with the same exact amount of money if we've invested in the same things over that time, assuming everything's the same, tax rates, investments, everything. As long as everything's identical, everything is identical, including the outcome. Most people think, well, but it's tax-free, it's better. No, it's not, because you pay your tax up front. So you pay your tax up front and it's tax-free later, but you've already paid the tax. So you could say, well, if you pay it later, you're paying more tax. No, you're not. You're still paying 30%. So you're paying 30% today, you're paying 30% later. What it means is you have less money now to invest. So if I have 10,000, Doug has 10, he's got a Roth, he pays 30% on that 10. So he's got 7,000 to invest. I start with 10. My 10 grows up to 100, his grows up to 70. Now I've got to take out 30%, so now I've got 70. We have the same exact amount. Run the numbers yourself. It's not a hard calculation. And so we all naturally think that these things are true. And we don't stop to actually figure it out for ourselves. We have a whole culture in this world of people who don't think, they just take what's given to them at face value. And that's why people are celebrating, Charlie Kirk's murder and all that. They're celebrating because somebody told them that's a good idea to do that. And these people are brainwashed. So, people don't think, the news tells you something. Well, this is true. Trump's a deranged maniac. Is he? Or do they just tell you that? Right? Is Israel good? Is Israel bad? I don't know. But I guarantee somebody's told you what to think. Whether it's the news or your friend or your favorite, podcaster, it doesn't matter, right? We all go along with what we're taught to think. You have to think for yourself. So something like tariffs, I was like, you know what? They got me. I didn't stop to calculate it myself and realize, wow, look at how small this is. We're all subject to this. I failed in that, and it was an aha moment for me. Now I'm going to go back and actually calculate it. So that I can see the impact based on what people are saying, because I guarantee no one else has done the research. So if you really want to have success in finance, in investing, and in life, do the things other people aren't doing. Do the homework. Check the facts. Make sure they're correct, which means you have to know how to check it and where to check it, which is a problem in itself. But, do your own research. Come up with the calculations yourself, especially if people aren't giving you numbers, they're giving you feelings. Oh, it's going to be bad. It's going to be good. That's a feeling. Give me numbers. Why is it going to be bad? Why is it going to be good? Give me numbers. Most people don't have them. So I want to bring that up as a framework. It's an important one. Half-truths are very dangerous to your financial health and your overall well-being. So do your own homework. All right. I want to dive into some things around. I wanted to dive in one more thing, and I'm going to hand it off to Doug. So if you haven't read the Wall Street Journal commentary by Treasury Secretary Scott Bessent, read it. It's quite good. I'm going to read from parts of it, just because it's worthwhile to read. Not because I agree or disagree, but I think it's interesting because he's making decisions, and so it's an interesting take on what's going on. The Fed must change course. Its standard toolkit has become too complex to manage. With uncertain theoretical underpinnings, simple and measurable tools aimed at a narrow mandate are the clearest way to deliver better outcomes and safeguard central bank independence over time. All right. I know I've already lost people to snoozing, but just you can.
Come on, Kirk. It's Friday. People want to go to the cabins and vacation.
I know. You can listen to this before bed and it'll put you right to sleep. But I want to read it because I want you guys to understand this. So one might think that new tools created after 2008 and the centralization of financial markets would have given the Fed greater insight about the economy's direction. At a minimum, all those gain functions should have allowed the Fed to steer the economy more effectively. That didn't happen. In 2009, the Fed forecast that real GDP would accelerate 4% in 2011. Instead, growth slowed to 1.6%. Cumulatively over that period, the Fed's two-year projections overstated real GDP by more than $1 trillion. Repeated misses demonstrate that the Fed placed too much of its faith on its own abilities and in expansionary fiscal policy to spur growth. When the Trump administration shifted towards tax cuts and deregulation, the Fed's forecasts were too pessimistic, underscoring its reliance on flawed models and neglect of supply side effects. Successive interventions during and after the financial crisis of 2008 created what amounted to a de facto backstop of asset owners. This harmful cycle concentrated national wealth among those who already owned assets. Within the corporate sector, large firms thrived by locking in cheap debt, while smaller firms relying on floating rate were squeezed as rents rose. Homeowners saw their property values soar, largely insulated by fixed mortgages. Meanwhile, younger and less affluent households shut out of ownership and hardest hit by inflation missed out on all the appreciation. By failing to deliver on this inflation mandate, the Fed allowed class and generational disparities to widen. Its pursuit of a wealth effect to stimulate growth backfired. Now, basically what he's saying a bunch of stuff, but basically what he's saying is the Fed is failing at its job. And it started in the last 10, 15 years or so. And now I would argue probably before that, but especially in the last 10 or 15 years. Now, people in the financial markets have been complaining about this for a long time. The Fed is not doing a good job. In 2020, in the middle of COVID, Trump had to yell at Powell to reduce rates because he wasn't doing any. Was it Powell? Powell was in 2008, right?
No, that was pre-Powell. That was was it the lady that became the Treasury Secretary?
No, it wasn't Yellen. Yellen was after.
Okay. Who was that?
I'm drawing. Anyway,
I'll look it up.
Look it up. But anyway, so the Fed chair at the time would not drop rates, despite the fact the whole global economy was shut down. And Trump berated him to do that. And finally, he said, "Okay, and we're going to underpin the whole economy with we're going to buy every piece of paper that's there." That happened because Trump yelled at him to do it. The Fed is always late. They're always wrong, and they're frequently causing more problems than we should have otherwise. Inflation is not a natural effect. It is an artificial construct that is created by the Federal Reserve. Also, we have the Fed, which is, as Besson said, and he is correct, is that the Fed policy is causing wealth disparity between the haves and the have-nots. People think the rich are the problem. The rich are not the problem. The Fed is the problem because the rich, they are smart enough to know what the Fed's doing and to follow the policy, which is own assets. As long as the Fed is inflating, as long as they're printing money, as long as their policies are the wealth effect, own assets. The problem is, as he says, younger families can't own assets. They can't buy real estate. It's too expensive now. So they're left out. And that's why we have socialists in New York becoming mayor, because people are fed up with the existing status quo. It's the French Revolution, let them eat cake all over again, because people don't have, and I've said this since I've started work and realized this, you will never have a revolution in this country as long as people have a white picket fence, 2-car garage, and 2.5 kids. As long as they have the quote unquote American dream, you're not going to have a revolution, because people have too much to lose. But when you don't have that, what do you have to lose? That's why, was it the Arab Spring when the guy lit himself on fire because he couldn't eat?
It's
When
why
people
it's
have
taken
nothing
down
to
every
lose.
Middle Eastern dictator.
Yeah.
Absolutely. That's why.
Yeah.
That's why Libya, overthrew Gaddafi.
Gaddafi, right?
Yeah.
So let me just finish. I can give it to you in a second. So the point being is, these things happen because of Fed policy. Now, the Fed's not only to blame. I'm not putting it all on their policy, but what they're doing is causing this problem to be exacerbated. They're making it worse. The middle class has been destroyed because, in large part, of Fed policies. Not only the Fed. I'm not putting it all on their shoulders, but in large part, they are to blame. And they have a mandate that isn't even their mandate. Their mandate is full employment and price stability. What the hell does employment have to do with the Fed? What the hell does price stability have to do with the Fed? The Fed's job is to remain the wealth effect. Well, if the stock market goes down, we need to boost it. That's their policy. And by the way, their main policy is to keep the banks from failing. But they don't talk about this. During the Biden administration, they tried to force down the Fed's throat that they are a part of climate change. They need to help with climate change. It's total bunk. So, I will be frank. I think the interest rate should be back at 5%. I don't think they should be dropping. I don't think Trump is correct. However, I don't see the numbers they see. So, but I don't think it should have been dropped. I don't think they should have dropped before the election. I don't think they should be dropping it now. I'm happy they are, because I benefit. I'm an asset owner. I'm buying a house. I own investments. I'm an asset owner. So I love the fact they're dropping it. But at the same point, it's not the right thing to do. If I was in charge, I would not be dropping rates. I wouldn't, because we don't need to. But like I said, being selfish, drop them to zero. I will benefit for that. So will everybody else who owns an asset. So as long as this policy is in existence, I can hate it, but at the same time, I'm not going to change it. So why don't I take advantage of it? So anyone out there who doesn't own assets, own assets. If you own assets, own more of assets. As long as this policy continues, you need to take that. Tact. Now, if that changes, right? If they change policy, well, okay, let's figure that out, right? If they're raising rates, if we have high inflation, I'm not saying go all in at the top of the market. That's not what I'm saying. I'm saying, as a macro level, forget what the market price is. The theme is own assets, because they will appreciate as debts will devalue over time. So anyway, that's my kind of lesson for the day, I think. And then there's another quote that Scott had right after that, which I thought was hilarious. I want to put this up somewhere. It says, all the PhDs over at the Federal Reserve, I don't know what they do. It's like universal basic income for academic economists. That's the quote of the week. I love that one. It's universal basic income for academic economists. I totally agree. Anyway, go ahead, Doug. I got more to say, but I'm sure you do too. So,
well, first of all, so it was Powell. Yellen was the chair up until Powell, and she left in February of 2018. Powell came in. So let's be very clear. This relationship between Powell and Trump goes back a long, long time, and so this has been something that has been brewing extensively. You talked about it's always fun to catch up with some of the points that you say and try to kind of wrap it around, because I'm just my my mind is going a million places. But one of the things that we are absolutely seeing here is that there is already a concern, slightly that, because we're seeing Treasury yields rising immediately after Fed cut. So, even though there was 25 basis points, long-term Treasury yields have risen, especially in the 10-year. So investors are demanding more return on long-dated bonds, despite expecting future rate cuts. And that suggests the markets are not fully confident with the sustained dovishness that they are giving out there. They're still signaling caution too, which tells people, wait a second, you're dropping these rates. We're trying to spark, but again, we've been through this before. There's no clear cut outlook right now. Powell came back and said, well, it's going to be a meeting by a meeting approach, careful data dependent path. There's no promise of sharp pivots. The markets aren't picking up on that. By the way, I do want to give credit to the people that that stayed in, continuing to bet in the bet in what's the markets that do the betting on Fed rates. You can Poly something. Yeah. Congratulations, you finally got one right. I mean, how many times have they said the rates were going to change and they didn't? So I guess staying the long game. But you are seeing gold and silver rising because of these rate drop hopes. Precious metals are rallying. I mean, you talk about where it's gone. Gold had 5 straight weeks of gains after the Fed cut, signaling more easing maybe ahead. Silver, now it's moving. That reflects belief that lower rates and looser real policy might devalue cash and currencies. That makes metal hedges more attractive. And some institutions like Nomura have added forecasts expecting rate cuts now in October and December, but even they expect modest easing, not a full switch to loose monetary policy. Markets are hedging this, and you talked about the concern of those in the middle class or the younger generation that are again, where should you be right now? It is it's just like the 80s. It was great for people that had assets. I know people that had enough cash that they were getting tax returns, where they had to report $80,000 in interest in 1 year. I mean, and by the way, 80,000 is a decent income now. 80,000 back in the 80s, I mean, we're talking something like getting almost a $200,000 salary just from the cash you had at banks. Okay, that is insane amounts of return for doing nothing for the haves versus the have-nots. Real estate is out of reach. That would be one of the places where there could, obviously be a longer term type of appreciation. And it's almost impossible or too expensive to go out there and buy gold. And gold bars, even the small ones at Costco, are thousands of dollars worth right now. So, but where are some places they can turn? Thankfully, and this is why you're also seeing the younger generation really get behind crypto and Bitcoin, because they're looking at something that they can grasp onto that they hope will be, reversely correlated to a decline in the value of the dollar and this Fed policy. That remains to be seen whether or not that will come true. It has so far, and so that's been kind of a saving grace for those that got in early. But now, I mean, you can't just run out there and expect you're going to be able to buy $120,000 Bitcoin, 25, whatever it's at, right? Today. So, but there is good news on that. There is, one of the things that has changed. We like to talk about, sometimes things happen. Well, this time it's different. It's not. It is a little bit different now, okay, than it ever has been before. It used to be there were things. There were market makers. Market makers helped us try to stabilize the stock market. They were forced to buy when there was an extensive amount of sellers and be able to create liquidity and sell when there's extensive amount of buyers and kind of stabilize that. It didn't always work. If it did, we wouldn't have the crash of 87 and other crashes beyond that. But those market makers have almost been pushed to the side. They still exist, but now we have a retail sector that 20 years ago had no access or a limited access to be able to go direct into the markets. Now, with the rise of Robinhood and Schwab continuing to get bigger and bigger, and TD with and all of these different ways that that people can now trade, they have access in ways that they never did before. And really, if you want to look at the new market makers, those new market makers are the high frequency traders. They're the ones that are really dictating where the markets are going to go from there. When it starts to hit, computerized levels, bam, hits it, all of a sudden you can almost predict the sell-off. problem is you're just not able to be fast enough to beat them. And that's part of the problem. So you've got to get, this is where the preparation, this is where looking ahead matters. You've got to plan accordingly. If your wealth strategy is going to assume the Feds were always going to save the markets, remember, like Kirk said, the rescue is about banks, not about your portfolio. Look what happened a couple years ago. The Fed stepped up and created the bank term lending program to keep these banks alive after Silicon Valley, because it didn't matter what they do, they will mismanage, they'll be stupid with their money, even if their CEO is on the Federal Reserve. And guess what? It wasn't until they were about to go under, and yeah, they'll say it was to protect the people that were the clients of those banks, and maybe they were, but a lot of them were worth extensive amounts of wealth from Silicon Valley, and a lot of them were obviously very well tied into the political party at the time. Don't think those handshakes don't occur. That was a lot of it to protect them. They created a program temporary to create this liquidity. You need to line your hedges. You need to diversify your assets. And as I said, you have more opportunity than you ever did. This time it is different. You can actually go get gold. You can get it through an ETF. You can have access to that. Is it going to be the same as holding gold? No. There's lots. I talked about this, I think, last week. There's a big argument between, what is the real price of, say, the futures market of an ETF versus holding gold. If you hold gold, it's probably going to be worth more than it looks on paper. Okay, that's a fact. Try to go buy gold from someone. They're going to outcharge you what it is. But at least it's something, and you can see it. Those things are going up. Silver's starting to go up, and you have access to it. You have access to Bitcoin now. Now, I know the Bitcoin hodlers are going to say it's killing the mandate. Whatever. It's not exactly the same, just like gold, but at least you have access to those partial, accessibility through this, through different types of investments like ETFs. So you can get things that will at least move up in this economy, even if you are not one of those that has the means or the wealth already. You just need to be prepared. And this goes back to what Kirk's talking about. You can't be passive. You've got to change it up. You got to, it's good to have cash reserves. It's good to have diversified assets. Why the cash reserves? Well, interest rates are going up on that. If we get back to 18%, great. But it's also about being able to be flexible and liquid and know that you've got access to capital. You got to design real income streams, so you're not hostage to policies where the primary goals are banks. You're gonna have to notice. You're gonna see that liquidity injections, again designed to calm banks, will often spill into stocks. Will often spill into real estate. They will often spill into precious metals. That'll fuel the very asset inflation that frustrates younger would-be investors, but obviously then can still be an opportunity for you to keep up with these policies. It's not neutral. Every rate move and balance sheet operation is going to be filtered through the question, will the banking system survive this? And so that's going to create a higher amount of volatility. But the key is you do be prepared and look at productive assets early, even those small stakes. So inflation and compounding can work for you, not against you. If you're just relying alone on income, very dangerous. The wages rarely outpace asset growth over long cycles. This policy risk is real. Fed decisions are going to widen or they're going to narrow wealth gaps. And if you don't build a plan that assumes, so don't build a plan that assumes that cheap money is going to be there forever. If you don't own these assets, you're on the wrong side of compounding. The Fed did not invent that math. It's just accelerated it. So the good news is, that there is opportunity to come into owning, not just earning. The wealth gap has widened to where there's a lot of concerns. Long-term returns on capital like stocks, real estate, and private businesses have outpaced wage growth and will likely continue to do so. Thomas Piketty did some research that showed that when the return on capital exceeds economic growth, those who already own assets pull further ahead. And yes, at some point, they have done studies on this. And you look at cases in the past that have shown at some point that is where the real threat of Arab Spring, the real threat of French Revolution, or whatever type of destabilization of your system starts to come into play, just like in Cuba and other places, is when that spread gets too big. Cut out. I'm gonna finish this and I'll get it back to you. But you want to cut out the half truths. I like what you talked about Roth IRAs. I want to add a little bit of a piece to that, Kirk, because I thought that was really interesting. The other thing about Roth, you're going to see a lot of advisors who are going to use this as a way of hoping that you're not educated, and that just telling you to look at, I'm magical, I'm a great advisor because I'm going to kick, I'm going to fix taxes, and I'm going to go ahead and I'm going to get you into a Roth conversion. Look at all the tax I can save, and just do Roths. And the reality is that they're praying that you haven't done your research, that you're not, just like listening to the news out there, that you're just going to be in your echo chamber or completely ignorant. And the reality is not only does that, not only does what you're making in the tax bracket you're in right now matter, it also makes a difference as whether or not you can pay those taxes by withholding, or if you have money on the side, because if you withhold, then you're going to move, let's say it's 100,000 a Roth, you only move 80 over to the IRA, you lose. And the third is, how long are you going to live? Because you've got to look and, got to understand that there is going to be a break-even period, and it might be 15 years before you can make that back. And that's not even dependent on Fed policy, which can then change whatever those rates are going to be. So you need to understand that education, and that timing is going to matter. And these are the half truths. The last thing that I'm going to say is, if you are planning to retire, and you're planning to retire in the next 5 years, it is more critical that you understand this than anyone else. I've done the studies on this. I've looked at the numbers. Kirk, do you know anybody in 2008, or let's say 2000 or 2020, that said, hey, I was planning on retiring, but the market just crashed and now I can't?
I mean, I don't know anybody today.
Right. I'm talking at the time when that market crashed, and then they're like, oh, my plans, my retirement just got decimated.
Yeah, right? I mean, that happened to a lot of people.
It happened to a lot of people. But guess what the research showed? I've done the numbers on this, okay? And I've looked at these through different types of assumptions of running worst case historical scenarios and retiring and with clients who have certain amounts. And what if you had retired at that time? Stagflation, great financial crisis. It's really interesting. What I have found is a pattern that the people, and I can look and say, well, what if you retired right before that crash? What if you retired during that crash? What if you retired after that, or after that crash? This is all about stress testing where you're at with your income. Time and time again, when I look at someone who was retired during the crash, during the event, whatever that was, stagflation, .com, or Great Recession, versus someone who retired right before, who do you think overwhelmingly was better?
Don't know.
Overwhelmingly, the people that retired into or during the event. In other words, what's the takeaway from that? Is that once the crash already happens, that's when people panic and say, now I know the risk. The car crash is ahead of me. I can see the car crash already happened. I saw it. Now I need to drive more safely. And the reality is that time and time again, the pattern has shown is that the people that retired right before that event are the ones that ended up having the greater challenge their retirement. And this makes sense driving too. You were at more risk of the car crash happening in front of you that you haven't seen yet than you are of the car crash that already happened. What's the takeaway here? The takeaway here is that people are completely complacent. They are looking at everything that's going on right now and they're thinking, it's wonderful. Look at all the money I can make. Look at my position. My portfolio is here and I'm going to retire and it's going to be there and I need it. That's not the fact. The fact of the matter is that the risk, we talked about this, Kirk, the risk is always there. It's just whether or not you've seen the result of that risk and you're experiencing it. And it's coming, which means the time for you to be prepared is not after you see the crash happen. It's now before the crash occurs.
Yeah, I think it's a really important point. And, the perspective we have is always in the present. And that's just the nature of, who we are as human beings. So we're looking at things in the present, and perspective is, it's interesting. I've been through a bunch of these situations before. I lived through the dot-com bubble bursting. I started in December of 99 in this industry, so all I saw was basically a crash for 3 years. I lived through 2008, lived through 2020. So I've seen this multiple times over and over again. And the one thing that is it's interesting, it's terrible, but it's interesting, is that, you know, when times are good, people think they last forever. When times are bad, people think they'll last forever, right? We have this present, opinion of where things are going, but the reality is that though they don't last forever, things change. But we don't have the perspective to, hey, maybe I should not be all in at the top of the market. Now, I know some of you are like indexers and you're all in the S&P. Well, that's great, but as a student of history, I can tell you that's a scary thing. I could be wrong for the next 10 years. It could keep going up. But my point is, if you're not prepared for it not going up, that's the problem. So a lot of people just say, oh, it'll come back. I'll just wait. It'll come back. I hear this all the time. 2008, I got a referral from a client. We had him out of the market, so he was happy. And he's like, oh, you got to, to one of his coworkers. He's like, oh, you got to talk to Kirk. You did a great job with me. So I talked to her, and she's like, oh, I really love what you're saying. Let's reconnect when the market comes back. When the market comes back, you want to talk about how to protect your wealth after it comes back. Okay, I'll never talk to you ever again. Like it's people have this weird sense of the way things work, and it's totally normal, by the way. But it just, to me, it's weird. And so when you see these things happening, like people are all invested. They're like, oh, it's great, bull market. Like I think it could very well go higher because I think Trump is a unique president that could make things happen where normally they wouldn't. But if Kamala was president, I'd be out of the market right now. I'd be scared. Not because of her, just because she's a typical politician. There's other things I don't like, but that doesn't matter. She's not president. But, even if it was someone else, it's just the typical politician would not handle things in the same way. So Trump gets I don't want to say he gets a pass, but he kind of gets a wild card that he'll typically use. So all this to be said is that you need to manage risk, especially at times like this. We like precious metals. We like mining stocks. We think that they're great, and there's a lot of opportunity there. And I'm bought in. We're early in the cycle. It's going to keep going because they're not going to stop printing money. They're not going to stop dropping rates, and precious metals should do great. There's a reflation trade. Assets are going up. What does that mean? That means you got to own assets. Gold's an asset. Silver's an asset. People are buying silver and gold right now. Retail public's buying silver. Mining stocks are up like 100% this year, or at least the ETF. It's up like over 100% this year. People aren't even talking about it. People aren't even talking about the biggest bull market going on right now. They're talking about AI and international stocks and Nvidia and all this stuff. What are they not talking about? They're not talking about nuclear, which frankly, there's not a lot of ways to invest in it, but they're not really talking about it. And they're not talking about precious metals. They're not talking about the most commodities are in the toilet, but the few that are doing well, no one's talking about them. Why is that? There's many reasons for it, but I just think it's odd that people aren't interested in the handful of areas that are doing well. I mean, copper just took a dump in August. I think it was late July. Went from 5.8 down to 4.4. It was a huge drop. And now it's climbing a little bit, but you've got some of these. I mean, silver's going crazy, gold's going crazy, and platinum's actually done pretty well in the last 7 months. But the reality is people aren't talking about this stuff, and as long as they're not talking about it, means people aren't invested. As long as they're not invested, that means when they do get invested, when they hear about it at the end of the year, when they see what are the top performing sectors, oh my God, it's gold miners. Wow, I need to put all my money in that. That's when all of the tidal wave of funds get into the ETFs, and then it really starts to skyrocket. this happens in any sector, by the way, but most people don't look at mining because it's not sexy, right? AI is sexy, NVIDIA is sexy. But here's the thing about NVIDIA, and I don't mean to call them out, but I just heard this morning and I thought it was interesting. So NVIDIA is one of the quote unquote best companies in the world, at least by market cap. And it's grown so large. It's grown so large that the market cap is now roughly worth 52% of the Chinese stock market, 60% of the Japanese stock market, and 110% of the UK stock market. So put that in context. If NVIDIA think of how long it's going to take the UK stock market to double. It's going to take a long time. How long is it going to take NVIDIA to double? I mean, it's gotten so large, it's going to be hard to, because I get this question all the time. Should we invest in NVIDIA? Should we invest in AI? I think we missed it. I think we missed the run. I'm not saying it won't continue, but we missed the meat of the run, right? People took advantage of that. It's overvalued, in my opinion, way overvalued. It's not a bad company. It's just overvalued. China just came out, I heard this week, with they have a company that's competing with NVIDIA. Now, I don't know if their chips is good right now, but how hard is it to go buy one of NVIDIA's chips, reverse engineer it, and create your own version? Probably not very hard. So, Intel became a commodity. How long is it going to be before NVIDIA is a commodity? Not long. The Chinese do a lot of things, equal. You could argue whether they're stealing it or what, but that doesn't matter. They're doing it. And they're always cheaper because they do it basically at cost for no profit. So that's going to squeeze all the profits out of that market. And what's left? Not a very profitable company, apparently. So I would be very cautious about semiconductor stocks right here. And I'd also be very cautious about AI because I've said this before, AI can change the world, but I have a sneaking suspicion that AI is getting a little too big for its britches. And I think people think it's going to do a lot more than it is. And there's a lot of CapEx spent on AI so far in corporations, and we're not seeing the profits from it. CEOs will tell you this. The profits are not being seen from AI. So if that's the case, is spending going to continue? Is AI going to keep growing? Or is it just kind of like a shiny object that we got excited with for a while because it can write our research paper and that's it? We don't know. I don't know either. I mean, I'm on both sides of the fence, but I'm on both sides. I'm very excited for what it potentially could do. And I'm also on the other side of the fence looking and saying, you know what? Don't get overexcited because this could very well do nothing any more than it's been doing now. And it could be just a better version of this. It's kind of like the iPhone. Like, oh, iPhone like 52. It's got another pixel in the camera. Like, So I think that's something to look out for. Just something to think about. I want to share one chart. We didn't share any charts today. I want to share one chart before we wrap it up. And Doug, you're gonna love this one. So apparently there is already a recession afoot. For adults between 18 and 64, there is a recession. So specifically for those adults. Now, this recession is the worst kind of recession. You're not hearing about it in the news, but it is a terrible recession, and I feel bad for people who are in this recession. And the recession is in the percentage of adults who have sex weekly. Apparently, somebody decided to do a chart on this, and I don't know how you get the data, but I saw this chart and I just had to laugh. There's a sex recession going on. So in 1990, 55% of the people were having sex weekly, and in 2024, only 37%. That's horrendous. We need to do something about this, Doug. We need government intervention. We need the government in your bedroom to help intervene into this, to help this recession go away.
Is that supply side or demand side?
Work? What?
Is that supply side or demand side?
I don't know, man, but I know lower interest rates fixes everything. So we need to drop rates to get rid of that recession. Anyway, I just had to drop that little humor before we drop because that just made me laugh. Anyway, Doug, you can wrap it up here.
So hey, listen.
Hard to beat that.
I have no idea how to beat that without still keeping this PG. Yeah. So, but I will say this, and there is definitely a bigger issue with that is at play, and there's talking about the plummeting population crisis. I mean, there was all this stuff going on about China, and for a while, and again, this tells you where people are wrong and the half truths. There was so much focus on too much population, too many people, that that was going to just suffocate economies. That they ended up killing births in China. They are suppressing births in India, and of course now we're seeing an organic suppression of births everywhere in the world. And now they're realizing that the problem was never too much population. We weren't that far ahead of really what was needed to sustain human race. Now, though, there's all these charts coming out about how we have got to have more births, or we are going to get into a significant decline. And if you don't think that decline is going to, impact you economically, I mean, we can see some of this going on in Japan, and it's been going on this way, on there for 30 years. They don't have enough youth to support their economy for the hugely aging population. And so I think there's so much more we could unpack about that. But listen, I think the key, some of the summary is: are you preparing for today's risks? I think that's a really important summary for today. Planning for today's economy, not yesterday's. Are you investing in planning for today's risks? Are you still using a playbook for the old economy? You were talking about the individual that you spoke to that said, "Oh, I'll just wait till the stocks are back up and then I'll call you." Right? Think about groceries for a second. If you could buy 10 lemons for $10 instead of 5 lemons for $10, you would load up every day. Yet in the markets and the economy, people do the opposite. They buy when the prices are high and then they freeze when they're on sale. And that's what happens when we follow half-truths and outdated rules. And the same danger applies to college planning. You're still using strategies built for a world of low inflation, predictable tuition, or you're still even using the strategies built for last year. They just passed one big, beautiful bill that's going to change everything for tomorrow. And you can be ahead of that trend or you can be behind. And it's just like assuming a 529 or buy and hold portfolio will carry you. You know how many people's 529s didn't keep up with college? Most of the people I talked to. You're planning for the old economy. Today's reality is different. Fed policy moved first to protect banks, not your portfolio. AI and high-frequency traders have replaced the old market makers. Inflation and college costs are stealth taxes on affluent families. Writing a 6-figure tuition check without a plan can quietly sabotage your retirement income. And let's also know that retirement stress tests show a counterintuitive truth. Retiring after a market crash is often safer than retiring right before. So the real danger isn't the risk you see, it's the one still ahead. Like driving past that car wreck. You're safer behind it than in front of the next hidden curve. So you need to ask yourself, are you still planning college funding the way you would have 10, 15 years ago? Are you still investing for the way your parents used to invest? Or the way you even used to invest 5, 10 years ago versus investing in today's economy? Have you stress tested how your plans would look and the income and the opportunity and the wealth you can have for the things that you love to do that matter, so you don't live a life of regret in today's economy? And if your gut's been whispering that your plan or your advisor's advice isn't kept up, it's time to listen to it. I know it's hard to make change, but change, and it might be uncomfortable, but is the only way you're going to have growth. So be early to the trend of a smart economy, and be early to the trend of smart money. Visit mergentadvisors.net. That's MERGENT, mergentadvisors.net, or mergentcollegeadvisors.com. If you're really focused on putting your kids through school and funding college the smart way. Let's build a strategy that's designed for today's risks and today's college costs, not yesterday's assumptions, because the difference between keeping your wealth and watching it erode isn't luck, it's all preparation.
Awesome. Well, thanks for coming on, Doug. That's the show for this week. Thank you again for joining us, Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast in the podcast app if you're choosing. You can also check out the podcast on, excuse me. You can also check out the show at moneytreepodcast.com. On the website, you'll have access to the show notes, resources, and the archive shows. Please check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a short rating and comment on the podcast app of your choice. Don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. Please send him an email, express your feelings. If you're seeking financial advice, talk to an oracle or a fortune teller, or maybe just a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything. But I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do. So invest in your life.